Okay, we finished our journal entries. Now we're going to move to our T accounts. A T account is called a T account because it looks like a big T. Each account has its own T account. There'll be one for cash, one for accounts receivable, and so on. In fact, I'm going to go ahead and put the names of the accounts in here. And I'm just doing it on the same order they were in our transaction log. The T account is like our ledger. So it lets us know what the balance is for each account. If you can imagine, if someone said, how much cash do you have? And we had to look through all of our journal entries, it would be a bit of a chore. So this is going to allow us to consolidate it and let us know what the balance is for each account. Revenue. Oh. Dense. Okay. Revenue. And I'm going to give each type of expense its own account. We could consolidate them. For our purposes, we'll keep them separate. So we have payroll expense, rent expense, and depreciation expense. Okay, so the next thing we're going to do is we're going to take each journal entry and we're going to record the debit and the credit in the proper T account. So for journal entry number 1, we have a debit to cash. So I'm going to put transaction number 1, and on the left side of the T account, I'm going to enter $200,000 in cash. We credited stock, so I'm going to go down here to our stock account and put transaction number 1 and enter $200,000 on the credit side of the T account. Transaction number 2, we debited inventory and credited accounts payable for $5,000. So I'll go to the inventory account and put transaction 2, and I'll enter $5,000 on the debit side. And then I'll go to accounts payable and enter transaction 2 and enter $5,000 on the credit side because we debited inventory and we credited accounts payable. Transaction number 3, we have a debit to equipment and a credit to cash for $72,000. So I go to equipment, transaction number 3, and I debit $72,000. And I go to cash, this is transaction number 3, and I enter $72,000 on the credit side because we decreased cash when we bought equipment. Number 4, we're going to sell consulting services, debit accounts receivable, credit revenue. So transaction 4 gives us a debit in the accounts receivable line item, and it will give us a credit in revenue. Transaction 5, we're going to do the same thing. We're going to debit accounts receivable and credit revenue, this time for $70,000. So 5 is going to debit accounts receivable, and down here we're going to credit revenue. Okay, I'm going to move this over here. Transaction number 6, we are going to debit payroll expense and credit cash. So transaction number 6, we're going to debit payroll expense for $10,000, and we're going to credit cash for $10,000. Transaction 7, we're going to debit rent expense for $5,000 and credit cash for $5,000. So transaction 7, we're going to debit rent expense, and we're going to credit cash. Transaction number 8, we are going to debit cash and credit accounts receivable for $50,000. So transaction 8, we got some more cash in. That's good. And just go up here to transaction 8, and we're going to credit accounts receivable because we decreased that account. All right. Now we have our AJE. And our AJE, we debited depreciation expense and we credited accumulated depreciation. So I'm just going to type in AJE1, and we debited depreciation expense. And over here under accumulated depreciation, I'll type AJE1, and we will credit accumulated depreciation. Our final transaction, we debit dividend and credit cash for $10,300. So transaction 9, we're going to debit dividends for $10,300. And we are going to credit cash because we decreased cash for $10,300. Okay. So we have all of our entries recorded. Now we have to total up our T accounts so that we know at the end of the period how much is in each account. So for the first one, we're going to, and we're going to add them up by taking the debits and the credits. So whichever is bigger will tell us which side we're going to put the total on. In this case, our debits are going to be bigger. So I add up 200,000 plus 50, which is 250, and I subtract out, let me see, 82, 87. I'm going to need a calculator for this one. So I'm going to say plus 200,000 plus 50,000 minus 72,000 minus 10,000 minus 5,000 minus 10,300. And something has gone wrong. And I ended up with 152,500. So now if someone asks me how much cash do we have, I can tell them 152,700. And I don't have to look through all of the journal entries. So I'm going to go ahead and do this for each of the accounts. For accounts receivable, which has a natural debit balance, we have a debit balance. So we have 50,000 plus 50,000 plus 70,000 minus 50,000 gives us a balance of 70,000 in accounts receivable. Inventory, this is easy math because there's only one entry, so it's 5,000. Equipment has 72,000. When we get to accumulated depreciation, it has a credit balance. So instead of putting the balance on the right side or on the left side under the debit balance, I'm going to put it on the left side under, or on the right side under credit. Sorry, I got that all mixed up. Let me say that again. Because the balance is on the credit side, we're going to put the total on the right side under credit. We'll do the same thing for accounts payable, stock, dividends. I'm just adding these up, and depending on if I have an ending debit or credit balance determines if I put the total on the right-hand side or the left-hand side. Okay, the final thing I'm going to do is to show that I have added these up. In accounting, when we show we're done, we put a double underline under the balance that shows that we're done. So I'm going to just highlight all of these balances and give them a double underline so we know we're done. All right, now we know exactly how much money is in each of our accounts. The next thing we're going to do is take our T accounts and turn them into a trial balance, and we'll do that in the next video.